All right, so let us start the meeting. I know you're here on the basics of investing, and I want to introduce you to our speaker. He has quite an extensive resume, and I didn't know where to begin, so I'm just going to basically highlight his resume. He has extensive experience in the foreign hedge and mutual funds. He was the chief financial officer of the Tiger Management, and he was responsible for the financial tax, performance, and management reporting of the U.S. Cayman, Netherlands. It just goes on and on and on. Basically, the bottom line, he's an expert on investing, and he's a CPA, and he's a professor here at Queensborough, and he teaches accounting. And I'm very delighted that he took the time out today from his very busy schedule to talk to you, the students, about the basics of investment. So let's give a nice round hand of applause to Professor Nolan Altman.
Thank you. Thank you. This presentation is the end product of a discussion I had with another professor when we were kind of lamenting the fact that a lot of students were coming into class and you're all in your 20s or even older and don't really have a decent enough, what we thought was a decent enough background in investing or knowing about investments. And what we considered was, and why it says here for either business or non-business majors, is that there are certain events in your life, whether you are an art major or a business major, that are all going to affect you that have to do with investing. So many of you are going to consider buying a house or saving up for a house or buying some kind of a place to live. Or certainly you're all going to consider retirement at some point in time. And in order to do all of those things successfully, they're all going to involve investing. And so what our idea was at least to present you with enough information that if you didn't understand everything and you didn't have the time to go through this all yourself and you wanted to deal with some other professional that did deal with this, at least you'd understand what it is that they're talking about and you'd be able to ask questions and understand what the issues are involved in setting up a portfolio and understanding what kind of investments are out there and the considerations that you should have when deciding what to invest in and what not to invest in. So that was the purpose of this presentation. And you can see the goals here are just to deal really with the concepts dealing with successful investing. Hopefully, if not now, you all will start to earn more than what you spend. And then the question is, well, what do you do with whatever's left over? You want to make it work for you as hard as you had to work to get that money to start with. You all have different economic life goals. You will have changing priorities. You may be starting careers now. You may be changing careers in the future, right? And all of those things will play into what kind of portfolio and what kind of investments you may have. And your financial stability may change. You may be a student now full-time, but you may want to be in a position where if you wanted to change careers, you'd like to have a year's worth of savings to fall back on so that you could do something completely different. Or you'd like to not be concerned that should there be an economic downturn again, that you would be out of luck and you might have to take some position that you really don't want to take. So financial stability is an important concept. All right, we have a quote here from Winston Churchill. Do you all know Winston Churchill? Prime Minister of England during the war, World War II. Saving is a fine thing, especially when your parents have done it for you, right? If we were all lucky enough to be born into money and we didn't have to worry about saving and we didn't have to worry about investing, that would be great. But that's probably not the case. It wasn't the case for me. It's probably not the case for most of you. And so we have to be in control of what it is that we do in terms of savings. I just want to tell you two quick stories about Churchill because he's a pretty unique character in history. Churchill was a hard-driving, hard-drinking, cigar-smoking man's man. And there was a woman who was the first woman who was elected to Parliament by the name of Lady Astor. And Lady Astor couldn't have been more the opposite. First of all, the fact that she was the first lady in Parliament, I think that kind of sat wrong with Churchill. But she was a society lady. And the two of them had this ongoing feud back and forth continually during their lives. And so there was one point in time when they were at some kind of a state dinner when Churchill had had too much to drink, and he was drunk. And Lady Astor walked up to him and made sure, she said in a voice that was loud enough for everyone around to hear, "Mr. Prime Minister, you are quite drunk." And Churchill looked at her and said, "And Lady Astor, you are quite ugly. But tomorrow I'll be sober." Right? And then there was another time when they were at a tea party and Lady Astor was going around pouring tea, And she got to Churchill and she said to him, if I were your wife, I think I would put arsenic in your tea. You know, arsenic is a poison. And Churchill said, well, if I were your husband, I'm sure I would drink it. So that was what was going on back and forth between these two. But here what Churchill is basically saying is that if you have money to start with and you don't have to worry about where it's coming from, that would be a nice position to be in. But it's not the position most of us are in. So let's start off by talking about what the difference is between saving and investing. Okay? Saving is the part of a person's income that's not spent. So you make $50,000 a year, you spend $40,000 for living and entertainment and whatever else you have expenses for. What do you do with that other $10,000 that you've saved? Okay? Investing is the use of the money in the hope of making more money. So you want to take that $10,000 and you want it to work for you, to try and grow into something more that you can use in the future. There are three goals of investing, and the first one is to beat inflation. And I'm not sure if we all know what inflation is, but inflation is the general increase in prices of goods year after year. All right? So if I have $100 today, and there's some positive inflation rate, now it's about 3% a year, every year that goes along, if I were to keep just that $100, I would lose 3% of my buying power. So after the first year, I could only buy 97% of what I could have bought in the first year. After the second year, even less, on and on and on. So one of the things that we want to do with investing is to make sure that at least we're keeping up with the rate of inflation so that I don't lose any purchasing power from my savings. This is a graph of historical inflation rates, and you can see that although there have been some significant spikes in this period, and we're talking about a very long period here, in general, we're talking about 3% would be the average, would be about the average rate of inflation. And we're about here now, we're about 3% currently. And this is something that's checked up. There are government figures that are run. You can certainly look this up. It has to do with the CPI. What you want to do is make sure at least you're keeping up with the rate of inflation so you're not losing purchasing power. There were certain periods in history, though, where inflation got completely out of hand. And those are periods called hyperinflation. And here you can see this happened in Germany in the 1920s. And if you can tell from the picture on the left, that woman is taking Deutschmarks, which are the equivalent of dollar bills, that's the currency, paper currency, and she's burning them for heat. Because inflation was moving so quickly that the price, the cost of the heat was more than the value of these Deutschmarks. They kept going down and down and down in value, so it was just like burning paper. And on the right-hand side, you can see a child there who is using bundles of these Deutschmarks as building blocks. I mean, can you imagine, giving somebody a lot of money and having your kids playing with them as if they were toys? So here you see that the value got so low that it wasn't worth the paper it was printed on. There was a point in time after the crisis in 2008 where there were American entertainers who were entertaining overseas, and the value of the US dollar was falling significantly. Nothing like this, but it was still falling significantly. And those entertainers said, I don't want to be paid in dollars. Pay me in euros, which is the currency used by many countries in Europe, or pay me in yen, Japanese yen, or some other denomination that they felt that would hold its value more than the US dollar was holding its value. Now here's something, this goes back to 2008, 2009, but I thought it was kind of interesting to show you. Zimbabwe inflation hits 11,200,000%. All right? It's hard to even fathom what that means, 11 million %. But if you can read the one on the bottom, it says, in February, the price of a loaf of bread in the country was less than 200,000 Zimbabwe dollars. On Monday, the same loaf of bread cost 1.6 trillion Zimbabwe dollars. So if you got paid on Friday, the first thing you did was run out and buy stuff, whatever it was. Because if you waited till Monday, the value that you could get for that payment that you received on Friday would almost disappear. And so this is major, major inflation. And what do you do? What do you do when you're in a country that has this kind of inflation, where costs are going up the way that they were going up? Well, it says earlier this month, Zimbabwe introduced a $50 billion bill. All right? As the country battles to fight cash shortages stemming from the world's highest inflation rate. The official rate was 231 million%. What does that even mean? 231 million%. It means that it's worthless. And if you were in Zimbabwe and you were conducting business, you would not want to take Zimbabwe dollars for services or products that you sold. You would want to get dollars or euros or some other currency that you knew had some value in it. And here's a $100 billion bill. How many of you have ever seen a $100 billion bill, right? But when your loaf of bread costs $1.3 trillion, you can't lug around a lot of singles. And so this is what they started to produce. All right, the second goal is to achieve financial goals, okay? So, like we mentioned, large purchases, if you're going to buy a home, if you buy a car, if you want to save for education purposes, or maybe even for children's education purposes in the future, right? So you want to create some kind of a nest egg that you hope you'll be able to seed with some money, invest it wisely, and have it grow to the point where it will be there when you need to make your purchase. And then we have general financial security is the idea that if something should happen at work, if there is another recession, at least you don't have to worry. You've got something to fall back on. You have a safety net of your own. And then finally, what we all will hopefully go through is retirement. Now, they have been talking about Social Security and revamping Social Security for decades. And what will end up happening by the time you're ready for retirement, who knows? So it's important now for us to make sure that we kind of take control of this ourselves to make sure we are prepared for retirement and not be necessarily dependent on whatever is going to be coming from the government in the future. How do you decide how to set up a portfolio? How do you decide how much risk to take when setting up a portfolio? And there are two different views. There are those people who are considered risk takers, right? Like these people who are running from the bulls. It takes a lot of risk. Anything goes. You know, people who go to casinos, they bet the house. It doesn't matter. They just need that action. And then there are other people who are risk averters, those who don't like risk at all, and they steer away from it. And that's kind of known as belt and suspenders, right? If you have a belt, that keeps your pants up. If you've got suspenders, that would keep your pants up. Belt and suspenders, that really keeps your pants up. So these are people who are risk averse, and they don't want anything to do with risk. And what you would do is you actually come up with what's known as a risk profile. Now, everybody sitting here is going to have a different risk profile because there are going to be certain questions that are asked that you will answer in your way, and the combination of all of those answers will help you to determine how much risk you want to take in an investment and an investment portfolio. And we have a handout in the front that you can pick up on your way out that has a number of websites on them, or you could just Google it yourself and you can just put in risk profile, and you'll see that there are questionnaires online that will ask you these questions. And if you answer them however you want to answer them, they're usually, from 1 to 10, and you answer with a certain point value. And then at the end of the questionnaire, it'll say you scored X number of points. This means you are a moderate investor, or you're a conservative investor, or you're a growth or a risky investor. And that will help you to determine what kinds of investments to go into. So what kinds of questions would they ask on this profile? Well, they'll ask you about your own personality. Are you a conservative, a moderate, or an aggressive person? Right? And everybody is different. They'll ask you about your age. First, they want to know your actual chronological age, because the one thing that most of you have here is the fact that you're all still very young. And so your time horizon is very long from this point out. And we'll see why that is so critical in a few minutes. The other thing they'll ask you about in terms of age is what kind of experience do you have? Have you been doing any investing before? Have you invested in just stocks or mutual funds or fixed income? Or have you done more alternative investments? What kind of experience do you have and what are you comfortable with? How about financial positions? What is your current financial position? What kind of level of savings do you have right now? Do you have a secure income stream? Are you comfortable that wherever you're working, you can stay there as long as you want to, or at least into the future as far as you can see, and you'll be earning a regular wage, so you don't have to worry about losing your job or having your wages cut back? How about your prospects? Maybe you're in a place where you're expecting to get advanced in a couple of years or in a year, and in doing so, you're going to start to make even more money. Right? So that would figure into your financial position. And then we've got your time frame, the time to achieve your individual goals. And again, like I said, to the extent that most of you sitting here are young, you've got much more time to worry and to think about how to invest for the long term. All right? So with the risk that you might take on, and if you're going to take on risk, there's something that you want back. You want a reward. Okay? If I'm going to risk my money investing in something, somebody better be paying me in order to do that. So we want to look at rewards that go along with the risks. And the rewards in investing are returns. So what kind of returns could you expect to get? Well, there are interest returns, right? So if you invest your money in an interest-paying investment, whether it's a savings account, if there are any left that still pay interest, it's hard to find them now. But if you invest in bonds, for instance, right? Bonds are obligations by a company or some other organization where you're actually lending them money. And for the right to use your money, they're going to pay you. That's what interest is. It's the cost of the money, right? So it's a fee charged by a lender to a borrower for the use of borrowed money, the cost of money. All right? How about if you invest in equities, in stock of a company? You go out and you buy McDonald's stock or Apple stock. Well, those companies are corporations, and they will pay you dividends. Some companies will pay you dividends based on how much they're making. So the better those companies do, the more they might pay out to you. Now, depending on the growth cycle of that company, they may want to retain their earnings and use that to grow themselves, or they may pay it out. So you have some companies who are growth-type companies like an Apple, which is still growing, or new startup technology companies, and they're likely to keep any kind of earnings they have so they can continue to grow. And then on the other hand, you have companies like, let's say, Johnson & Johnson, who are more mature companies, stable companies, and they're able to pay out dividends based on their earnings because they know they're going to continue to earn a certain amount every year. And so dividends are the payments made to shareholders out of a company's current or retained earnings. The fact that you go out and you buy an investment that's in a marketable, that's sold on a public market, you can then turn around and sell that investment. Okay? The difference between what you buy something for and then what you sell that same investment for is going to be called a capital transaction. And you could have either a gain or a loss. So a capital gain or a loss is the difference between an asset's purchase price and sales price. Right? I go out and buy stock at $10 a share. I end up selling it at $15 a share. I made 50% on my investment. And that's what a capital transaction is. The total return is what's considered when all things are combined. So if I'm investing in a fixed income security that pays interest, or I'm investing in a stock that pays a dividend, my total return combines the difference between my purchase price and my selling price plus any current income I received on either interest or dividends. And that's my total return on an investment. All right, and here we have just a picture of a risk-reward type of graph. And what you can see here, and what you would expect, is that the lower, we're up here, the lower the return, the lower the risk, okay? The higher the return, the higher the risk, right? If I was going to invest my money with the U.S. government, and given all the problems we had for the last year or so, but if I'm investing my money with the U.S. government, I have a pretty good idea that I'm going to get my money back, as opposed to if I invest my money with the Zimbabwean government, when I don't know what I'm going to get back, right? So if I'm going to invest it with the U.S. government, and I know I'm going to get it back, it's relatively safe. And that means that they're going to have to pay me a much lower rate of interest. If Zimbabwe wants to attract my capital as an investment, they're going to have to pay me a tremendous amount of interest, and then I'm going to have to just rely on the fact that they even have it to pay me when time comes to pay it off. Okay, so low risk, low return. High risk, high return. And here's just a listing of different types of investments. And if you start from the bottom, you can see the lowest volatility. Volatility is the range of prices that you might expect to see in a security. So we've got lowest potential return on the bottom and highest returns at the top. And so if you start on the bottom, you've got cash and savings accounts and CDs. And as you move up, you have non-FDIC insured investments, right? So that means non-guaranteed by the government investments, then treasury bills, then you move up to stocks, which are equities, Move up even further, you've got real estate, and we saw what happened in 2008 and 2009 with real estate. Then you've got smaller company stocks, international stocks, and then you get into some other more volatile types of investments like commodities, precious metals, other commodities, and then derivatives, futures and options. Okay, so again, the lower the risk, the lower the expected return, the higher the risk, the higher the expected return. Here are two quotes by Benjamin Franklin. Time is money, and a penny saved is a dollar earned. So what do you think he was trying to get at here? What do you think the point of this quote is? Anyone? All right, the whole idea here is that there's something that relates investment performance to the time period involved. Okay? A penny saved is a dollar earned. If I can put away my pennies today, I'll be rewarded with dollars in the future. And this is very important in terms of portfolio management and investing. And we know that Benjamin Franklin knew what he was talking about because they put his face on the $100 bill. So he must have had something to do with this. So I'm going to give you all a choice. Show of hands. How many of you would like option 1 or option 2? Now, option 1 is I give you $1 million. All right? I give you $1 million, and you don't invest it, you just have $1 million. Option 2 is I give you a penny, but I'll double that penny every day for a month, for 31 days. Okay? So how many of you would choose option 1 to take the $1 million? Nobody? Nobody wants the $1 million? Oh, a couple people? All right. How many of you want option 2 to take the penny? Ugh, look at all these people who want the penny. All right, well, let's see what happens. Here's the first 10 days. People took option 1, you got $1 million, right? At the end of the 10th day, you still have $1 million. People in option 2, you're looking good. You're up to $5.12. Anybody want to change? No? Yes? Some people want to change? All right, well, let's look at the next 10 days. All right, people with option 1 are still sitting with $1 million, but the people with option 2, you're up to $5,000, all right, $5,200. Anybody want to change now? All right, the last 10 days of the month. If you took a penny and you doubled it every day for 31 days, you'd end up with over $10.7 million. Okay, this is the miracle of compounding. And you can see what the effect is. Now, doubling a penny every day is like getting 72% rate of return, 72% interest. And it's very hard, obviously, to find anything that pays 72%. So this is really for illustrative purposes only. But the idea about compounding interest is a very important concept that you all need to really be aware of it. In fact, Albert Einstein himself said, compound interest is the 8th wonder of the world. Those who understand compound interest are destined to collect it. Those who don't are doomed to pay it. And let's see how that works. We have two different kinds of interest calculations, simple interest or compound interest. So in simple interest, all I'm doing is I'm paying you interest on the principal. And I'll show you examples, but if I had $1,000, I invested, and I say I'm going to give you 8% a year, every year you're going to get 8% of the $1,000. Okay, you'll get $80 every year. But in compound interest, not only am I getting 8% in that first year, I'm getting $80, but I'm also going to then start in year 2 to get 8% of my original investment plus any interest I had before. So I'm getting interest on my interest, and that's why it grows as much as it does. So here's the example, $10,000 invested at 8%. Right? On the simple interest side in white, every year I'm just going to get $800 a year. And so at the end of 20 years, I'll end up with $26,000. That's 8% simple interest. But if I compound that interest, and I get interest on my interest, in year 1 I would still get $800 on my $10,000, but in year 2 I'm going to get more than that because now I'm getting interest on $10,800, 8% on that, and then on that, and on that. So to the end, on the 20th year, I'll end up with $46,610. You can see the difference between a simple interest and the compound interest. It's almost 1.7 times more in compounding interest. Here's just graphically, you could see that the longer you go on, the steeper that curve will get. So the more you have built up in interest, the more you're going to receive in compound interest, and the more you're going to end up with your investment, like we saw the $10 million at the end of the 31 days with the penny doubling. You can estimate how much your compound interest will get you by using what they call the rule of 72. To approximate the number of years it'll take to double your money, divide 72 by the rate you can earn. So let's say you could go into an investment and you could get 3%. If you take 72 and you divide it by 3, you'll get 24. So it would take approximately 24 years to double your money if you got 3%. It would take you 8 years to double your money if you're getting 9%. And in our case, which was the penny problem, it would take 1 year to double your money if you were getting 72%. Now, warning. It works both ways, right? We're talking about the good things having to do with compounding interest, but if you owe money to somebody, if you owe money on a credit card and they're charging you interest, what's the next bill that's going to come in? It's going to be charging you for? It's going to charge you on the balance with interest. So you can get into a position, if you have a balance on your credit cards, where you're paying much more in interest than you ever owed for the original purchase. And that's why it's really important to monitor and watch what it is that you charge on your cards, and to make sure that you really use your card for the purpose of convenience, as opposed to going out and using it to extend your credit and create some kind of a liability that you have trouble with. The other thing, in terms of we're talking about investments, is it works in terms of losses. So let's say if you invested $10,000 in year one and you lost 40%. Right? That's $4,000. What rate of return would you have to earn in year two to get back to where you started? Okay, so I start with $10,000, I lose 40%, that's $4,000. The balance I have after year one is $6,000. Most people, or not most people, many people will say, if I lost 40% in year one, then I'd have to make back 40% in year two, and then I would be back to where I started. Doesn't work that way. Because what do we see now? After year one, my balance isn't $10,000. My balance is down to $6,000. So if I make 40% now on $6,000, then I'm only going to be getting back $2,400. And so my $6,000 plus my $2,400 is $8,400. I didn't get back to $10,000. So when you lose money, and you're trying to recoup that through an investment return, you need more than what you lost in the previous period. And these can be significant, especially if you think about what happened in 2008 and 2009. So how much would you need then to get back to where you started? Well, if I needed to get $4,000 on top of my $6,000 that was left in order to get me back to $10,000, I would really need 67% return. And how hard is it? I mean, it's hard enough to get 40% in a year, let alone 67% in a year. So you could see what a big difference that is. Here's the growth of $10,000, again, just reflected in different potential choices of investments. So if you stuck it under your mattress, you'd get 0 return, right? In fact, not only do you get a 0 return, you have a negative return, because every year there's inflation. And so your purchasing power in future years is going to be less than even that first year where you put the $10,000 under your mattress. 3% was the historical average for savings accounts. It's clearly not now. 5% is the historical average for bonds or fixed income investments, and 11% was the historical average for equities, stock investments. And you could see what a tremendous difference there is between if you invested all of your money in stocks or you invested your money in savings accounts. But realize that with reward comes risk. So it's riskier to invest in securities than it is to put it into a savings account, and that's part of the reason why you're getting that kind of a return. Don't put all your eggs in one basket. How many of you heard that old proverb, right? You don't want to be put in a position where everything you have is in one equity, one asset type, one geographic area, because if something should happen, you're out of luck, right? If I invest all my money in Apple and then for some reason Apple goes bankrupt, I have nothing. Okay, so this is leading us into a discussion about asset allocation, very important. All Okay, the process of dividing investments among different kinds or classes of assets. All right, so the first thing we're talking about are different classes of assets, types of assets. Stocks, bonds, real estate, cash. And the whole idea is that what we were trying to do here is we're trying to come up with a risk-reward profile that matches what we're trying to achieve. So I'm going to invest in these different types of classes in hopes that my risk will be lowered over all of my investments. All right, so I can invest in some risky stuff, but I want to make sure I invest in some safe stuff. And the overall risk-reward will be something that agrees with my risk profile as I set that up. Here are some different asset classes. Cash and cash equivalents, and if you've taken Accounting 101, you realize that's the first line on our current balance sheet, right? Cash and cash equivalents. So that's not only cash that you can take out today, but something you could turn to cash very quickly. Fixed income are bonds and those kinds of investments that pay interest. Equities are investments in corporations, so you're owning a piece of an interest in the company itself. And alternative investments. Now, alternative investments is a very wide class itself, and in there you might have commodities, currencies. Do you know that you can invest in currencies? I mean, we take it for granted. We buy things in dollars, we sell things in dollars, but you could buy euro, you could buy yen, or you could buy any other currency that's used, and you're hoping that the value of that currency against what you bought them in goes up, just like any other investment. Real estate, and then there are other alternatives like hedge funds and other pooled vehicles that you might be able to invest in. Here's, again, historical returns. And what we're trying to show here is that if you looked at the bottom group of squares, that on any given year, there's a very wide range here for stocks, right? From minus 40% to up 55%. Very wide range. But if you look at a 20-year period, according to this, all returns were positive after 20 years. So what this kind of tells you is that if you're investing for a very short period of time, be prepared for anything. But if you're long-term investing, then these are the historical averages. That if you had 20 years to wait, if you were investing for retirement, history tells us that equity investments are good investments for the long term, that they will produce positive returns, and they'll produce the highest positive returns. And you could see the other returns for cash and bonds are much lower, less volatile, but they also have been negative for certain time periods. This is a good chart because it's colorful. I like that. All right, so every one of these colors represents a different asset class. And so if we look at the columns are the years. So for 1991, the best asset class was emerging markets, returned 59.9%. It's tremendous, 59.9%. In fact, if we take a look, it was also the best asset class in 1993 and 1999. And 2003, and 2004, and 2005, and by that time you go, this is crazy. Why don't I just invest in emerging markets? It seems to do the best on all these years. Well, take a look at the bottom row. Take a look down here. Emerging markets in 94, the worst class in 95, the worst class in 97 and 98, the worst class in 2000. What are we saying? It's very volatile. You could make a lot of money, you could lose a lot of money in those classes. And so in this chart, you will see that the top row, which is the highest rates of return, are varying from relatively low rates of return, like 10%, to very high rates of return in the 60s or in the 70s, whereas even the lowest rates of return in some years could even be positive. Here's T-bills, 1.2 or 2.4. Right? But some years they were down, you'd lose 30% of your money. If I did 2008, it would probably even be more than that. So we want to see that all these different asset classes have something to do with an entire portfolio that we design so we could take advantage in all of these things, because the theory is that while some of these will do very well some years, some of them may do poorly. And if I spread my money out, in the overall, I will get a good return. So there are a couple of different asset allocation models. The first one is one that preserves capital. Suppose I have a certain amount of cash and I want to put it away because I'm planning on buying a house in 2 years. It's a relatively short period of time. I don't want to play around with the stock market. I don't know what's going to happen in 2 years. I need this money relatively soon. I want to preserve my capital. So if that were the case, then maybe I'm just going to go into savings types of investments or treasury bills or something that I know the principal is safe, I get a low rate of return, but at least I know the capital is going to be there when I need it. Or maybe it's an income model. Retirees have income models, right? They don't work anymore, so they want to have a portfolio where they can get out cash in order to live. So their portfolio would be set up to generate enough income so that they can do whatever it is that they want to do on a regular basis. Suppose you're very young and you have a much longer outlook and you're more prone to taking risks. You might invest in stocks that are growth oriented. So you want to get some of these new technology companies with the hope that they grow significantly in 5 years or 10 years or 15 years. And then there's a balanced fund. A balanced type of portfolio will combine both income and growth. So that might be the right answer for some people. The most important word that you always hear when you hear about real estate, where do you invest in real estate? You know, the three most important things to think about is location, location, and location, right? In investing, I would say it's diversification, diversification, diversification. So the idea here is that we don't want to put all of our money into any one something, because we want to be protected that if that one something goes bad, we're still going to be able to survive that period and grow. So the goal of diversification is to reduce the risk involved in building a portfolio. And when I spoke a little bit about volatility, volatility is limited when you diversify by the fact that not all asset classes or industries or individual companies move up and down in value at the same time or at the same rate. So you might have a year where equities go up and fixed income goes down, or vice versa, right? But as long as you've got all of that built into your portfolio, you'll be okay. Within a portfolio, you want to diversify. So within an asset class, it's important to purchase securities from a variety of industries so that poor performance in one area will not send an entire portfolio reeling. Right? You want to make sure that you're not invested all in one company. You want to make sure you're not invested all in one industry. You may want to make sure you're not invested all in one country. Right? All of these are ways of looking at concentrations in a portfolio and things to consider when you want to diversify. This is an example from an actual mutual fund from a while ago, and it's a pie chart that shows all the different industries that they're in. And this is what is known as a diversified portfolio. And if you can read the titles on the left, you can see they've got pharmaceuticals, electronics, aerospace, computers, oil and gas, on and on and on. It's almost like they have a piece of almost every different industry out there. And so this is an example of how they're taking 100% of their portfolio, invested portfolio, and they're diversifying it amongst industries. So if any one of these industries goes really bad, they've got all the others to go better. Hopefully we'll pick up the slack of the one going bad. You can diversify based on company size. So we're talking about big companies versus small companies, growth companies versus value, which I mentioned the difference between what those were. The individual companies themselves, industries that a company is in, the countries that they're in, or a geographic location even within a company. Because one thing to consider is, what if you were from Louisiana and you invested all your money in local companies around New Orleans before Katrina, right? That would be a problem because you have a heavy concentration in one geographic area in one country. And so this was another chart that they were using to show investors that they diversified not only among all of the United States, but you see in the lower left, they have international investments of 13%. And that is helpful in some cases when maybe the US economy is in a recession, but maybe the European economy is not, or the Far Eastern economies are not. And so again, you're trying to find different areas to invest in that will counteract the bad performance that you may find from any one segment. This is just an example of a very simple allocation for a portfolio. And this was used by a not-for-profit. So the total of the portfolio we know is going to be 100%. And you can see that it's broken up into different asset classes: equities, fixed income, alternative investments, and cash. But equity is not enough. So even under equity, that's broken up into US equity and non-US equity. But that's not enough. So then they take US equity and they're breaking it up based on capitalization size: large cap companies, mid cap companies, small cap. Then they break up non-US into European, emerging markets, and Japanese stocks, right, which are the more liquid markets to be in. And again, the whole idea is that you're diversified over all of these different asset classes and segments so that you hope that your total return will be a more healthy, reflective return. All right, how do you invest? Now you're thinking, all right, now I'm interested in this. How do I actually go about investing? Well, the first thing to consider is there are two different ways to invest. One is known as active investing, and one is known as passive investing. And with both of them, if you have a limited amount of funds to start with, the preferable choice that you'll probably hear from most investment professionals is to use mutual funds. So let's talk about that for a minute. Active managers rely on analytical research, forecasts, and their own judgment and experience in making investment decisions on what securities to buy, hold, and sell. What does that all mean? There are people out there who are professional analysts and professional portfolio managers. And they will go into different companies and they'll talk to management and they'll come up with estimates, how much they think they're going to earn, compare what they think this company is going to earn versus this company, figure out what the pricing is in the market, and they're looking to see that these companies are priced right. If I think that Coca-Cola is a better company than Pepsi, but Coca-Cola is selling for a cheaper price than Pepsi, then I'm going to start investing in Coca-Cola. And I might even go short on Pepsi and trying to make money that way, right? So they're actively managing the portfolio. They're in there looking at what the company does. They're interviewing people. They're interviewing consumers. They're interviewing producers, right? All these people to try to get a gauge for what kind of demand is out there and what their sales might be in the future. And they believe that they could do better by doing this work. And obviously, if you've got these people out there doing that, you're going to have to pay them for that. And so there's generally a fee that's involved with paying an active manager, which is higher than if you were to pay for a passive investment. So what is a passive investment? A passive investment is a style of management associated with mutual and exchange-traded funds where a fund's portfolio mirrors a market index. All right, so now what is a market index? How many of you have heard of the S&P 500? Right, or the Dow Jones Industrial Average, or the NASDAQ. These are all market indexes. And what those are a hypothetical basket of securities. So I put together, in the case of the S&P 500, 500 stocks that I think are representative of what's going on in all of public markets, and I watch how they go up and they go down. And I can now invest in the index itself. And so nobody's thinking about anything in terms of which company to buy and which company to sell. The fact that it's in the index, that's what I'm invested in. If those companies go up, I make money. If those companies go down, I lose money. And that's called passive investing because nobody's really making any buy and sell determinations other than the original investment itself. If you're investing in a passive investment, you would expect a much lower fee than you do on an active investment. And now there are tons of products out there that you can invest in. iShares and other kinds of index where you can invest in a full index like the S&P 500 or even just invest in a basket of technology companies or a basket of energy companies or whatever you want. You'll be surprised how many products are out there. Here is a chart that shows the difference between the three most popular indexes. Now, the Dow Jones Industrial Averages is only 30 stocks, right? There are lots of stocks traded on the public exchanges. But what they did was just took 30 as a representation of what was happening in the market, where the S&P 500 is 500 stocks. But look how close those two correlate, right? They're pretty much almost the same line. So it's pretty amazing that with 30 stocks, you can pretty much follow the same thing that would happen with 500 stocks. And when you hear that the market was up or the market was down today, this is what they're talking about. They're talking about the index being up or being down. On any day, the market could be up and your stock could be way down, and vice versa. The NASDAQ composite is a more focused composite of technology stocks. So that one gives you much more of an indication as to how technology stocks are doing as opposed to a broad-based, lots of different types of industry averages. All right, this one is a little tough to read, and the scaling is really poor. But what you can see in here, this is the Dow Jones Industrial Average, and you can see some major historical events here. What do you think happened over here in 1929? right? We've got a crash over there, right? And the same thing would happen over here where everything fell down. This was in 2001 after 9/11. But here's one that's more to scale. And what you can see is that the Dow Jones, it was pretty flat all this time. Very little change. Here's the Depression, this period here in the 30s, so you can see how close it is to zero. And then it moved up, and then we had in the 50s and the 60s were a period of expansion, but still, look on the range, you can see it didn't grow very much. It really wasn't until the 90s that everything changed, and the markets took off. And there are a number of reasons for that, and there are people still analyzing that and coming up with their own reasons. And part of this has to do with deregulation of investment securities. And that might be a lot to do with what you see is in tremendous growth now, and you also see tremendous declines when things go bad. So we had a recession here, and we had one here in 2008 and 2009 when we had a burst in the bubble for the real estate bubble, right? And that was an interesting period because even if you were 100% doing what I told you, diversifying across all asset classes, in 2008, you got hurt in everything. So even if you did what was right, you still could have been hurt. And that was, you know, that's a generational type of thing. We have not seen anything like that since the 1930s. All countries have indexes. And so you may have heard of some of these. Australia is the All Ords, which ordinaries are considered their common stock. England is a FTSE, which is the Financial Times Stock Exchange, right? So all of these countries that have stock exchanges have indexes that you can follow, and you can see how a country is doing. So I'd mentioned to you mutual funds. If you don't have a significant amount of money, how are you ever going to be investing in all these different products? Because you have a limited source of investment capital. And that's where mutual funds come along. Because the idea of mutual funds is that you only have a limited amount, but so do millions of other people. And if I took some amount from all of you and put it together in one big fund and invested it the way that I was talking about, then I'm giving you instant diversification. So for your investment of $100, if that's the minimum investment in a fund, all of a sudden you might be in 30 different countries, or 50 different industries, or hundreds of different individual companies that there's no way that you could do by yourself. And so that's the benefit of using a mutual fund when you don't have a significant amount of capital to work with. So an investment vehicle that's made up of a pool of funds collected from many investors for the purpose of investing in securities such as stocks, bonds, money market instruments, and similar assets. Unfortunately, over time, because of their cost, approximately 80% of mutual funds will underperform the stock market returns. That's pretty amazing, right? So you got a 20% chance of beating what the index would do. And that's why passive investing has also become so popular. Because if I'm going to lose money 8 out of 10 times by investing with a manager, why don't I just do it in the index itself? And at least I know what I'm going to get. A lot of managers, they don't want to take a lot of risk. So what they do is they compare their returns to the index returns. And so if they're investing in the type of portfolio that mirrors the S&P 500, their goal might be, I don't want to do any worse than the S&P 500. Well, if that's your goal, then why don't I just invest in the S&P 500 and pay a really small fee compared to paying you a big fee as an active manager? And that's something to consider. There are advantages for mutual funds. They're actively managed, right? They're professional managers who are doing this. They diversify, so as I said, you get instant diversification. And there's liquidity. At any point in time, you could generally tell them, I want my money back. And you sell the shares in your mutual fund, and now you have cash. So they're not guaranteeing you can get your money back, whatever you put in. You could still have a capital loss, but at least you can get cash out of your investment. There are disadvantages to mutual fund investing. The first one is it's actively managed. So that was a positive. It's also a negative, right? Because it's actively managed, there are higher expenses. You have no control over what they do. If they have the ability to invest in 30 different countries, and that's part of what they say they will do, but it turns out that they skew most of it to the United States or to one other country, and that's what you're going to get. So once you invest with them, you're giving them the ability to invest any way that they are allowed to invest based on the prospectus that they've given you. And there's a dilution of performance.
So remember the big chart, the pie chart with all those industries. Suppose I hit a home run in technology. Technology doubles, it triples, it quadruples, but it was only 1% of my portfolio. So how much money am I going to actually make when 99% of the rest of my portfolio isn't doing anything? So sometimes over-diversification can be a problem, and you won't be generating the kinds of returns that you think you will because that segment did really well. All right, I'll close out with another 2 quotes, and this one is Mark Twain. October. This is one of the particularly dangerous months to invest in stocks. Other dangerous months, July, January, September, April, November, right? I don't know why, but the fourth quarter of the year tends to be the quarter where there have been most market collapses and panics. And so there is like a collective inhale on Wall Street when October comes around, and an exhale when you get to the end of the year and nothing bad happens. But in any given month, you could have periods where there are declines. And then Woody Allen said, money is better than poverty if only for the financial reasons, right? All right, so I hope that, the handout that you have up here, you want to take one on the way out. It's got websites where you can actually do your own risk profile. It's got some websites that have a whole list of different planning tools that you could use, compound interest things. You can have savings where you want to build up for a house. How much would you have to return given X number of dollars, things like that. So you can play around with them. You can find your own on Google, but I think that those will be a helpful start, and then see where that takes you. Thanks very much.
Thank you. Thank you very much for giving our students some valuable information. So who's going to be ready to go out there and invest some money? Anybody? All right. Good, good, good. All right, so if you want some flyers about our upcoming seminar for next month, please come up and get a flyer. It's the blue one here. And the flyer of today, Investing Basics, is various websites here, so come on down and pick that up. Thanks for coming, and hopefully we'll see you next month again. Take care.